Hello guys, glad to have you on board again. Today, it's been a while since I wanted to record this video and actually to answer most of my French users community's questions that have been rising recently, not necessarily about throughout the English community, but I assume you guys have or will probably sooner or later have the same expectations. So I would like to anticipate the demand as well and answer all those basic questions I've been receiving throughout the latest few weeks, mostly surrounding the use of Bollinger Band within the pro indicator strategy. So just to set things really straight, as usual, there's no magic stuff with those indicators. So if you think like my trend channel algorithm into framework is what's going to bring you the money you're seeking forward for, you just got it all wrong. And that's definitely not the point in here. That's not what has value in those indicators. We'll obviously dig deeper into those informations later on in this video. But anyway, as an introduction, I think this is really, really important for you to understand. What's the goal of my work in here? What has value in here is the educational content I give you guys, and I always and will always do it for free. What has value in here is what I can teach you from my personal knowledge and my personal progress through trading, how I got to build my strategy, how it's orchestrated throughout a major goal, how you guys should head toward this goal as well instead of wasting your time into the stupid traps I myself have been gone down to back in the days. So I'm just trying to save you some time some way more than anything else. So let's answer the simple question. Can you use Bollinger Bands with the pro indicator strategy? The answer is freakingly yes. It's just, you can use whatever the fuck indicator you want. It's just, my strategy and what I'm trying to teach you with those videos on a daily basis or whatever is not how to use my indicators. It's just most likely how to fucking read the market and risk manage no matter what you use. If you use any different tools, then just switch the words I'm using to the words corresponding to your own strategy applications. Just take the frame I'm giving you guys. These are the way of thinking, the rules, because every professional traders just get to those rules again as well. So if you want to go toward professional trading, you might wonder how professional works and try to copy their behaviors rather than just trying to copy their strategies. All right. So like I said, my strategy is customizable to the top. You can do whatever the fuck you want with the strategy. Just be smart enough to replace the words that I'm using with my tools, obviously, but you'll find some similarities with other professional traders, and you can mix that up into your own personal vision of trading. Just the most important thing in here, and I cannot stress that enough, is that you need to be consistent when you get to learn trading, because learning a trading strategy is not meant to give you gains. It's just meant to teach you how to risk manage. The strategy is just how it works, and it's really important that you understand the strategies that are there to keep you boundaries, inside the boundaries of risk limitation, long enough for you to actually get to perceive what risk limitation is. It's a very complex and shadow area for beginners, but it takes quite some time to process that, but sooner or later you'll get there, and then you'll be really way more efficient into trading. Anyway, so now that this introduction is said, Bollinger Bands in my strategy. What do you actually guys think this is? Which step of the strategy are we talking about? The strategy is 3 steps. Like I said, every trader uses that. Just they might use different words or different terminology, but anyway, it's always the same structure. Contextualizing the market, knowing what the hell you'd be dealing with. Is this probably a trend? Is this a range? Knowing that you never know, but you can just assess what is going to be the most probable context to trade. And you need to do this in a non-subjective way, all right? It's not I feel because of this, it's just I see this and it generally stands for this kind of context more than this one, all right? Simple as that, all right? That's what you need to be doing with the context analysis. So for that, you need a context tool. The most commonly used ones are either trend channels or trend lines, standard technical analysis, the basics, but you need to know how to read that shit. Otherwise, if you're just drawing random trend lines on your charts, or trend channels, then you're not going to be really efficient as context identification. Moreover, what I actually figured out throughout the latest few years when I was focusing on how to efficiently teach guys how to trade, and what I actually figured out is that you're pretty bad at contextualizing the market. Back in the days, and for years, I've been working around the signaling tools and risk management tool, thinking that this is what you guys needed to be more efficient. But actually, that's not. What you first need is to really get to this freaking context answer. What the hell is the context you trade? Because you most likely trade what you think is going to happen, and that's pretty dangerous because you don't contextualize, you don't price filter, and searching for signals in those contexts is really like a dead end, pushing you toward probably losing the more you play. So anyway, that's what I figured out. That's the reason why I get to build framework in the first place. It is not a tool I actually needed. I knew how to contextualize, I knew how to filter out prices, but what I figured out is that you guys were pretty bad at it. So I built a tool for this, like a tool in which I put in all the rules I'm using personally so that you can eventually get a glimpse of how I think and how I risk manage. No more, no less. I decided to use the trend channels, and when you use this, all right, which is the trend channel version of the indicators, I was just using a switching template. It's really easy. So this is the trend channel version of the indicator. This is the Bollinger Band. Otherwise, this is how you guys switch. All right, it's not that. You get to double click on the indicator. Shit. All right. And this is where you get trend channels or Bollinger Band, all right, pro channels, which is just pure and simply an emulation of trend channels plotting on the charts. It's pure and simply this, all right. So yes, this algorithm is great because as far as I know, there are multiple tools available here and there, automatically tracing trend lines or whatever. They do a pretty bad job actually, but yes, I've done a good job with this trend channel tool and the way they can help you on figuring out which context you are into. And the feedbacks you gave me is that yes, you now are much more efficient at contextualizing the markets and stuff like that. So I'm glad the job has been well done. But anyway, I'm not here to brag myself. That's not the point. So the thing is, trend channels work efficiently. The algorithm does its job. At least it reaches out its target. The target were getting you better at context management and analyzing risk management toward prices analysis. But like I said, the trend channel is just one way to filter out prices. There are so many other contexts possibly usable in here. Like instead of trend channels, you can use Bollinger Bands. Maybe in the future I'll add some others, but I think those two gets to probably suit 99% people's needs. So why the hell do I need to add another one? I think those two does a pretty damn good job. Moreover, they have significantly different way of doing things, and that's what's important. Bollinger Bands are volatility based. Trend channels are price movement based, like forecasting the future out of what happened previously. Bollinger Bands is just like, all right, this is how far we're supposed to go, and we shouldn't go any further than that. That's two different ways of contextualizing and limiting prices. But still, they are both as efficient, or not, no, they have some difference, and I'm going to try highlighting those differences. But the other question I had is, Phil, can we actually combine the two? I think that can be done, but that doesn't necessarily, I don't think that's necessary. I think what's necessary instead is to pick one of those two and stick to it. Like, if you just got started learning my strategy, then I strongly suggest you stick to the trend channels. This is definitely the easiest way to contextualize because you have the sets of rules I give you with it. Like in the PDF manual, I'll give you the rules to figure out each and every context. On a day-to-day basis, these are the tools I'm using as well. So it's easy for you to figure this out using the contextualizing rules I gave you. I'm not really familiar with the Bollinger Bands. I'm testing them right now. I've been testing them for a week, and I already figured out quite some patterns I'll explain you today on how to eventually be sustainably contextualizing using Bollinger Bands. But I think the there is a lot more subjectivity in the readings you'll make out of Bollinger Bands, which in my personal choices, I would say if you're beginning in trading or trying to, or getting noob with learning my strategy, that just, you rather like to use the trend channels rather than the Bollinger Bands. It's more likely for experienced traders. But still, if you're a beginner and you absolutely, like, you've been studying some other strategies previously, like some other traders who was using Bollinger Band, and you pretty damn like that, then in that perspective, I would say yes, go for the Bollinger Bands and try to find a mix between my strategy and the other guys. And in that perspective, I would say definitely yes. At least in here, the bias is positively oriented. It's going to bring something good. As on the opposite, if you were just learning the pro channels, with the pro channels so far, and you somehow started to figure out what the goddamn context were, and now you say, all right, I've got a new tool, I'm going to play with the Bollinger Bands as they look cool. God damn it, you're just wasting some time in here, just like I wasted so much of mine back in the days, going from one strategy to another, to another, to another, to another, to an endless way of strategy learning that doesn't even matter today. This was a waste of time. So stop wasting your time. Focus on something. If you want Bollinger Bands instead of pro channels, then go for it and just stick to it. Is a key rule in here. I don't mind any choice you make. Just make sure you stick to it and don't change every couple weeks or something like that. All right? So now let's try to understand what the difference is. And you can combine the two, but I don't necessarily think it's actually worth it. It's probably going to bring more confusion than anything else, because Bollinger Bands behave pretty differently than the trend channels. Like I said, they're based on totally different visions of trading. The first one is more like what happened in the past is probably going to forecast, not forecast, but give technical areas of what's going to come next. All right? So we highlight technical areas that will probably matter because of what happened previously. The Bollinger Bands behave significantly differently. They basically say, all right, we've been moving that much previously, so we should move that much nowadays. Volatility either expands, the standard deviation rising, or contracts, the standard deviations contracting. And that's the simple binary way of seeing the market throughout Bollinger Bands. All right? The thing is that as Bollinger Band is volatility based, it gets way more efficient, but the problem is far less signals. You need to figure this out. These are leverage. You're gonna get far better trades. Like, let's figure out the difference. Like in here, let's highlight the areas in which the price have been crossing and getting into interesting areas. All right, in here, these are all the contexts you could have been trading. In here, in here, in here, and in here. All right. These are all the trading contexts you would have eventually been able to pick up. This is definitely breakout, all right, breakout, not enough for a pullback, so we keep on going. This is probably the divergence. So in here is not necessarily a trade, but just a profit taking. Oh, how surprising. Divergent structure, context. So, you know, the market is just like losing its pace. So this is definitely the divergent part of this trend. So this is the pullback, comes right after. This was a potential final excess. This was another one. This was apparently not enough, so the market kept going for another final excess and another before actually freaking reversing. So yes, that's how this thing works. All right, pure and simply. So these are all the trades you would have had with my strategy. Now let's figure out what you will have had with Bollinger Bands. It takes a little bit to compile. All right, so with the Bollinger Bands, so let's use different elements. With the Bollinger Bands, you would have traded eventually in here, all right? Not there. Bollinger Bands was expanding, and you would have waited for slightly better prices in here instead. You would have traded in here, yes, and you would have traded in this area. These are the three spots you would have traded, right? The first one, reaching out to the opposite trend channel. It works just the same, all right? The algorithm with Bollinger Bands is just instead of my trend channel algorithm, I'm using the Bollinger Bands, all right? So in here, you've got a context Bollinger Band, all right, which is this one. You've got a trend channel Bollinger Band, a trend Bollinger Band somehow. You also have your extreme channel Bollinger Bands if you want to, which is the Bollinger Bands on the higher time frame. Okay, and simple as that. Multi-time frame is absolutely necessary when you contextualize, because that's how it goes. You're trading out of what happens on the biggest time frame. It's really important for you to figure this out. All right, it's just that's how it works. You can use Bollinger Bands or whatever the fuck you want. Just make it multi-time frame, and this is how you get efficient with contextualizing. Anyway, so as you can see in here, 3 trades. First one, secured and probably stopped out later. Second one, same thing, entered, secured, and stopped out. And this one, entered, secured, and confirmed. God damn it. So the third one was the good one. With my strategy in here, though obviously the breakout is something that you don't fight. You're not selling in here, right? The break up, everything goes fine. You let it go, you ride the trend, all right? You would have done nothing but diverging in here, all right? So it would have been divergence. Like we said, the trade was probably secured as well, probably probably secured faster than that. Then the pullback trade, you wouldn't have been able to figure this one out, or eventually with the 20 moving average, but I think it was passing below those prices eventually. So pullback was hardly being able to be caught in this context. You would have just had this one, all right? So in my strategy, it's first divergence, pullback, divergence, pullback, final excess. So you profit take in here, you start selling eventually in this one, all right? Selling again in here after being stopped without loss. The trade gets confirmed, gets validated, all right? Same thing goes in here, second trade, validated, confirmed, and invalidated. Same again, validated, confirmed, and it goes on, all right? So one, not necessarily, 1, 2, 3 attempts, or 4 attempts to sell out of just 2 for the Bollinger Bands. That doesn't make a big difference. The finality is the same. You all of us, every one of us gets the selling entry. It gets the reversal to profit from. Right? It's just different visions, different way of trading, not necessarily changing a lot. It's just this one gets far less signals. Just 2 signals where mine gave you 1, 2, 3, 4, 5. All right? So you got way more signals with my strategy. Still, most of those signals are filtered out because of either the momentum being too aggressive or whatever. But anyway, more signals means also less aggressive signals. So what you'll get is more opportunities, and some of them will be less reliable. But that's how it goes. I'd rather like you guys to trade more, even if that means trading a little bit riskier trades, rather than trading a little once in a while with a trade that will, in the end, not necessarily be right or wrong. As you can see, this trade was good, just like mine, just like with the trend channel, and it ended up the same way. So most of the trades will end up probably flat extractions, or at least stop loss without losses. So both cases doesn't bring you the market top. It's always the same thing. You're risk limiting. You don't know what the fuck is going to happen. All you care about is to pick up a price that is interesting enough so the price can react for you to secure the trade. It's all we're seeking forward for. Not necessarily catching the market tops or whatever, or the market reversals, just highlighting technical areas in which the price are very likely going to at least retest on the opposite direction. So you can risk fucking manage and see what comes next. You never know what's going to come next. Neither with Bollinger Bands that you will do with trend channels. This is not the purpose. The purpose is just to highlight risk areas, low risk areas. So Bollinger Bands, like I said, less trades, probably better trades, but far less in numbers. Probably like 100% more trades, like double the trades with the trend channels. So you'll probably progress 2 times faster using the trend channels. Obviously, it will come with probably much more losing trades. Not much more, just probably a bit of more, a little bit less efficient in terms of who's good trade by trade, like winning trades or successful trades or failed trades. You'll have probably a little bit more failed trades with the trend channels, but still you'll trade more, though you'll progress faster. And I'd rather like you guys to opt for this solution rather than the other one, because you're not going to learn out of winning. And I always tell you that trading is learning by mistake. It's making those mistakes to just learn and grow yourself out of them, just to not make them later on. So the more you trade, basically the more you progress. So instead of seeking for the perfect trades, because you generally fear of losing, instead of fear to lose, just think of it as an experiment. If you don't throw the dices, you're just not experimenting a goddamn thing. So if you play a game saying I'm not throwing the dice because I fear we could get a 6, what's the point? In that perspective, just don't even throw the dices. It's more like, all right, if you want to see an experiment, see how much 6 you can get in a row, then yes, at least that's an experiment. But don't fear anything, all right? If you fear of trading because you only want to gain and never lose, then it's just waste of time. Just get the hell out. You're not meant for trading. Anyway, so let's make a few examples. So a few patterns I can give you to just translate what I taught you with the trend channels, with the Bollinger Bands, for those of you who want to be using this, or experienced traders with my strategy who just want to eventually try something else to see if they're like that, all right? Like if you're experienced enough with my strategy, like you're a yellow or an orange guy, you already figured out the goddamn risk management, so you already understood that this is not about the trend channels or the Bollinger Band. That's not a game changer, all right? It's just like if you like Bollinger Bands more than you will like trend channels, and if you can be a little bit more efficient with them, then just get to use them, all right? But you already figured out that this is not the point at that stage. This is why beginners shouldn't be playing that game, because your focus should be on learning the goddamn risk management first, rather than trying to switch the strategy rules or customizing things, all right? So anyway, just have a look at the volatility in a broad perspective. Volatility either contracts or expands, and that helps you identifying the context. When the volatility expands, just like in here, all right, volatility was contracting before it starts to expanding. So let's put a vertical bar, all right, and in here is the movement, is the moment it starts to maintain, all right, like we've maintained the level of volatility. In here it contracts, it starts to contract, all right. So this Bollinger Band starts to rise, even though this one still remains bearish, right? But anyway, then in here you've got a sideways kind of action, and in here the volatility expands again, then contracts, all right, till this point where it extends again, all right? So figure this out as being part of the trade. The problem with Bollinger Band is that they're lagging, all right? Because they're using moving averages, and that's why I don't like them for beginners, because you get late information, and contextualizing needs to be real time, or at least as fast as possible, because what you're trading is what you're trading right now, you know, right? So Bollinger Bands are great because they do have a very tough filter, price filter out of this, because we're using 2 standard deviations, which means generally most of the time prices are within the lesser standard deviations. But still, we're using 20 moving averages, 20 period moving averages, pretty late, which means in here you would have figured out the market is reversing at that stage. It would already be there. I wish you figured out the market was already ending its consolidation in those prices instead, all right? So when volatility expands, you generally know that you are trending movement or ranging in a different in a directional perspective, like bullish ranges or bearish ranges. It all depends on what happened previously, all right? Like in here, volatility expanded significantly to the upside, which means this was very likely just a bearish range, all right? The moving averages were still positive, so most of the elements in here suggesting this was just a bearish range. But this is suggesting, and that's what I don't really like with Bollinger Bands. They're really subjective, which means if you're already familiar with context with context analysis, stuff like that, you'll probably be good with Bollinger Bands, and that won't be changing anything. But if you're beginning, I think it can be less effective some way, because a little bit more subjective analysis, giving some room for personal interpretations, personal biases, and it is exactly what you need to dampen when you're just learning trading or not yet being matured in trading. The rest of the strategy will probably be just the same, like the difference to contextualize, all right, but you can still use a lot of those informations. They'll be the same, all right, so the algorithms detecting the breakouts and the arrows will be just the same, all right. You can switch between Bollinger Bands and conventional trend channels. Anyway, you'll have the same signals. That's what matters, because you really need to figure this out. I already introduced that notion earlier, is that if you figure this to be like, in terms of code lines, the number of code lines and stuff like that, consider it to be pro framework. All right, this is the big box of framework. All right, so let me delete the lines, actually, not necessary anymore. All right, this is it. So in this big box, all right, this is 100% of the code of framework. All right, this is like variable introduction. I use freaking numbers of variables, so don't mind me with that. That's how I always code it. I'm using a lot of inputs. Anyway, so variable declaration. Second step is probably same size. It's actually the trend channel algorithm. So you might figuring out that, oh, this algorithm is wicked. He must have spent thousands of hours to bring that thing up. It must be so complex. No, it isn't. Actually, it's a bit complex. Yes, it is. Obviously, the trend channel is not easy because there is actually acceleration factors and stuff like that that I had to optimize, and it's freaking complex as usual because maybe that's my problem, but I can't do things easy. Anyway, and now this is what actually matters into this thing. The rest is mostly for alerts and triangle detection. Like, all right, the triangle detection algorithm. Oh shit, that's not what I wanted. The triangle algorithm just basically and barely takes that. All right, it would be triangle detection and customized alert system in terms of, all right, percentage use of the overall code. And all right, let's use different colors. All right, okay, but the big part of this algorithm, what actually makes it valuable, where the value is this, the breakout algorithm. This is what really brings value out of any other indicators. Like I said, you want to use context indicators, just use fucking Bollinger Bands. This one is free, so you don't want to pay for my trend channels. Why the hell would you pay for trend channels? Automatic trend channels. God damn it, use whatever you want. Bollinger Bands is one of the many options you can use. Keltner channels, whatever. Just make it multi-time frame based and just copy my strategy. Make it a time frame based, make it a trend based time frame, and make it a context based time frame. And just by doing this, you'll be replicating my strategy with free tools, and I'm totally fine with that, all right? You copying my strategy, I'm really fine. All I care about is just not you selling my strategy to some others, and believe me, it happens. And I'm not really gentle with those guys because obviously that's definitely not what I stand for in here, definitely out of my personal ethics. If you take my strategy to sell it to someone else and for more expensive prices, go fuck yourself. So anyway, there are some people without ethic in this world, but don't fight it, just keep on going. That's how it goes. Anyway, so Bollinger Bands, use it, don't use it. You just get to what it changed. Lesser trades, probably a little bit more quality trades, but it also requires knowledge of contextualizing the market, because if you're just raw beginner, you're hardly going to figure out your context with just this. Second things I wanted to share is, yeah, what matters is those things. They're here to risk limits. So they work just the same. When you get into a context with a target or something like that, you'll know the market is likely going to do something with this area. Sorry. And remember that those signals must be contextualized. So in here, you would have figured out, all right, this is probably one of those targets that will limit the prices. You know how long they last. They last for 40 bars. So this one actually got overwhelmed, but that's no big deal, all right? Normally, this trade, you would have taken it, all right? This is definitely the kind of trades you take, all right? In here, it would be inside the context with a blue arrow, oversold cluster, and close to a target. So yes, you would have taken this trade. You would have been overwhelmed a bit, but remember that there's always risk management. So you have a stop loss for this. So you wouldn't have been stopped in here. The price would just have been trying to stop you out without success. But simple as that, all right? So anytime you get in the context, you can use the sine wave breakout informations to actually process things. Those things are also meant to help you contextualize. Remember that most of my context rules are using this, like you still get those informations like two opposite square signals means a mature range, all right? So in here you would have been figuring out that the range was this, all right? Sorry, that the range was probably that, all right? So triangle, bearish breakdown, pullback, bam, all right? So this kind of stuff, all right? Simple. These things are still usable. And that, like I said, this is what has value in my indicators. The trend channels fucking algorithm, yes, it's good, I think it's good, but it's not what really has value. I would never have sold such thing, all right? Like, actually, I'm not going to share my algorithms, definitely not, how I calculate the trend channels, but I would share that for free, like hidden code, but I'll give it away for free. I would never ever agree selling that kind of stuff. It barely took me 1 week or a couple weeks, let's say 1 week to build it up and a month to optimize it. Those things, they're fucking 5 years of experience and 5 years of optimization. So these has value. These, I'm okay selling them. The rest of it, definitely not. Definitely not. And like I said, those things, they will help you, but they'll definitely not tell you what to do. They're just risk management algorithms, no more, no less. It's just how I see the market. You don't see the market this way because you're not yet risk manager for most of you guys. And I'm here trying to teach you how this thing works. Like I said, those algorithms, if you don't have them, it's for you to learn them, which means you're going to have to learn it the hard way, figuring out your own patterns, trying, succeeding, failing, optimizing, succeeding, failing, optimizing, but you can do it on your own. Like I said, you don't want to buy my indicators, I don't nearly give a shit. Just do your own patterns. They'll probably be less efficient, obviously, otherwise I wouldn't be selling my stuff, but still, you can learn it like that, by trying and failing and optimizing. It's how I've done that in the past. I made it, so if I made it, you can make it as well. As simple as that. All right. What you're paying mostly is experience in here. It's no more, no less. Right. But definitely not knowledge. Like the actual valuable knowledge, aside from my algorithms and my patterns, is more likely my strategy, and this always will be for free, and I stand for this. Never, ever, ever, ever going to change. I'm not here with a big hook to just get you in, and then it will all be to be paid 2 months from now. It's no Christmas offer. It's no stuff like that. It's always going to be like that. I would be ashamed to make anyone pay for knowledge. All right. So knowledge is free, algorithms is paid, is how it goes, all right? Algorithms are experience more than knowledge. Anyway, that being said, I'm going to leave you guys with that. So Bollinger Bands, it is just fine. Just avoid getting into this if you're too much of a beginner with my strategy. I'd like to focus on the essential. Learn the goddamn risk management. Use the trend channels. They're probably more efficient to teach you this way. And then for experienced traders who want to try something new, then go for it. Try for a week and see if you can be more efficient with that. The patterns are most likely the same. Trade in context, wait for signals and risk managing to get into the trade. If you have none of risk management, just don't trade. As simple as that. The risk managements are always the same things. You've got the triangles, you've got the signals, and you've got the breakouts. Just sum up those informations and you'll know how risky is a trade. The riskier the trade, the larger the stop loss, the tinier the position sizing, the more aggressive the risk management is, the tighter the stop loss, and the bigger the position sizing could be. Simple as that. Don't see trades as black and white, just see trades as shaded gray areas. Each trade is different because each trade has a different risk limitation. That's just it. Anyway, stop. Bye, guys.